Hashtag Part 2, Pure Narration. The S&P 500 returned 10.7% last year. Your index fund returned 10.54%. That gap, that tiny, invisible gap, just cost you $67,000 over the life of your portfolio. Here is the first thing nobody tells you. When you Google S&P 500 return, the number you see is wrong. Not wrong because the data is bad. Wrong because it's measuring the wrong thing. The S&P 500 that gets quoted on every financial news channel is a price-only index. It tracks stock prices. That's it. It completely ignores dividends. But your fund? Your fund reinvests dividends. So when you compare your fund's return to the number on CNBC, you are comparing apples to a completely different fruit. The total return version of the S&P 500, the one that actually includes dividends reinvested, has historically outperformed the price-only version by 1.2 to 2% per year, depending on the decade. That means millions of investors think their fund is underperforming when it is actually beating the number they are comparing against. And some investors think they are matching the index when they are actually falling behind the real benchmark. Step 1 to fixing your returns: know which benchmark you are measuring against. Now let's talk about the most popular ETF on the planet. SPY. $500 billion in assets. The first ETF ever created. And it has a structural flaw baked into its DNA that costs you money every single year. SPY is organized as a unit investment trust. That's a legal structure from 1993. And that structure comes with a rule: SPY cannot reinvest dividends immediately. When a company inside the S&P 500 pays a dividend, SPY collects that cash. Then it sits there, idle, doing nothing, until the quarterly distribution date. In a rising market, that idle cash is not compounding. It is not buying more shares. It is just sitting. That is called dividend cash drag, and it is a real, measurable cost. VO and IVV, Vanguard's and BlackRock's S&P 500 ETFs are structured as open-end funds. They can reinvest dividends almost immediately. That is a structural advantage SPY simply cannot match. SPY's total cost to investors has historically exceeded its stated expense ratio of 0.0945% due to this cash drag, with tracking difference averaging approximately 0.10 to 0.15% annually in recent years. If you are holding SPY in a long-term account, you are paying a premium for brand recognition. That is not an investing strategy. That is a habit. Everyone knows expense ratios matter. But here is what they do not teach you. The expense ratio is not the real cost. The real cost is the tracking difference. Tracking difference is the actual gap between what the index returned and what the fund returned, net of everything. Expenses, trading costs, cash drag, securities lending income. All of it. And here is where it gets interesting. A fund with a 0.03% expense ratio can have a tracking difference of 0.05%. Or 0.02%. Or even negative, meaning the fund actually beat its benchmark after fees. The expense ratio is the sticker price. The tracking difference is what you actually paid. Always look at tracking difference. You can find it on ETF.com for every fund, updated annually. One number is marketing. The other is reality. Know the difference and you are already ahead of the vast majority of retail investors who never check. Here is something that sounds impossible. Some Vanguard index funds have beaten their benchmark index after fees. Not because Vanguard cheats. Because Vanguard has a revenue stream most investors have never heard of: securities lending. Here is how it works. Short sellers need to borrow shares. Your fund owns shares. Vanguard lends those shares to short sellers and collects a fee. That fee flows back into the fund, directly to shareholders. Vanguard's structure, where the funds own the management company, means that lending income goes to investors, not to corporate profits. It is a meaningful advantage, and it is disclosed in the annual fund reports if you know where to look. This is why VOO's tracking difference has been negative in certain years. The fund returned more than the index it tracks. That is not magic. That is structure. And it is a structural advantage you are either benefiting from or you are not, depending on which fund you chose.